Hi you guys, welcome back to the Firefighters Financial Toolbox. Today I got an email in my inbox from Personal Capital. Now I use Personal Capital to keep track of all my investments. Does a really good job of keeping your finances in order. So if you haven't checked it out, check it out at personalcapital.com. But anyway, they sent me an email today and it says, are you committing any of the seven deadly investing sins? Every investor makes mistakes. Some may not cause immediate harm, but others can have a major impact on your financial well-being. You need to know what they are in order to avoid them. There's a good chance you are in better financial shape than you realize, but failure to correct even one of these sins, let alone all seven, could significantly impact your ability to reach your financial goals. All right, so let's download it here. All right. 7 deadly investor sins. So this basically is saying the same thing the last one did. Okay, number 1, inappropriate asset allocation. We cannot repeat this often enough. Asset allocation is the most important investment decision you will make. Now, I agree with this 100%, you guys. And they break it down into traditional, obviously, your combination of stocks, bonds, and cash. With their tool, it breaks it down into international equities, domestic fixed income, international fixed income, alternatives like real estate or gold, and then cash. Now it goes into the thing about their retirement planner online, which actually is a pretty good tool. I use it myself once in a while. Okay, number 2, too much cash. Another deadly investor sin is holding too much cash. And this isn't a problem concentrated amongst retirees. It is rife across all ages and demographics. You guys, cash is not yielding anything. We keep cash because we have to spend money. We do have to keep a little bit of an emergency fund. But what they're talking about is people, for example, who go to cash when the market turns and then they don't buy back in. You can see here that over the last 10 years, now this is through 2017, but after the 2008-2009 downturn, a lot of people got psychologically impacted and scared not to be in cash. They still have that feeling that they don't trust the stock market. And so they've missed out the fact that we've doubled the S&P 500 since the bottom of 2009. The average real return stock of domestic equity, 8.8%, international 3.1%, domestic fixed income 3.2%, international fixed 0.8%. Down here, cash, negative 1.3%. And that's not even taking into consideration the fact of inflation. So that's important. Okay, number 3, paying excessive fees. Now, I harp on this on my channel a lot, you guys. Always try to minimize fees. Not all fees are easily understood, and many are embedded deep within investment products, making them difficult to see. Over time, they can be a significant drag on investment returns. Always know what you pay in fees, and they're advertising it on their board. When you put it in, it does show the fees, which is nice. Remember, we always want to look for a low ER, but sometimes they can have wrap fees. They can have other associated fees that you don't even know. And of course, if you have an advisor, I guarantee somewhere in there he's getting a fee. And those can range between 1% to 3%, guys. So that's huge. All right, this is another one that I take serious. Poor tax management. Number 4. Most don't like thinking about taxes. In fact, many investors distance themselves from the topic as it can be too complicated or too time-consuming or just boring. Like, I hate paying taxes, but it's important to understand them. However, improper tax management can cost you more than 25% of your long-term return. 25%, you guys. The 2 most common tax missteps are not taking advantage of retirement plans and using tax inefficient investment vehicles like mutual funds. So what they're saying there is, first of all, if you have some tax advantage space, be it a 401k, a Roth IRA, any of those things will allow your investment to grow without the slowing of taxes. Anytime you have a taxable account, you're paying taxes on all those earnings every year. When you get the dividends, even if you reinvest them, you're paying a lower. Now, it is lower, but it's still a drag. And then it goes into talking about tax inefficient vehicles. For example, if you have a actively managed fund, actively managed mutual fund in a taxable account, you guys, every time they do turnover in that fund, you pay for it. It's very tax inefficient. The other thing is if you have bonds, for example, in your taxable account, remember those are always taxed, or REITs, always taxed at ordinary income, so you don't get the break of long-term capital gains or qualified dividends. So it can make a huge difference in how much you end up. Failure to account for inflation. We talked about inflation a little bit ago. You guys, average inflation in the United States is about 3%, but that's the overall percentage, right? If you look at individual sectors, for example, healthcare, we may have only gone up 2% overall for inflation last year, but healthcare went up about 12%. And there are other parts of the market that go up at different times. And if you don't plan for inflation, when you get ready to retire, you could very well run out of money. All right, living off interest. This is brought down from the last generation. We're gonna put it all in bonds. We're just gonna live off the interest. First of all, we're not making any interest to make enough to do that, you guys. Now, there's some misconceptions out there that between dividends and interest income, it's enough to live on, and you would have to have a huge portfolio for that to be the case. Right now, 10-year Treasury's giving about 2%. So even if you had $100,000, that's $2,000 a year. Not going to be enough. So think about that. Oh, here's a good one. Poor debt management. No financial picture is complete without first examining household debt. The most common forms being mortgage and credit cards. So mortgages obviously is a necessity, right? You have to have a place to live. So to me, having a good fixed mortgage is probably, right now interest rates are low. You can get a 30-year fix for around 3%, 3.25%. Now, what if I'm only going to live in my house for 5 years? Then maybe an ARM might be a good idea for that if I know that I'm not going to stay in that house long term. But remember, if the interest rates go up, your mortgage payment could go up. Credit card debt, high interest debt, credit card balances, you guys. I don't need to harp on this. You know how I feel about that. If you have a credit card, pay it off every month. Do not ever carry high interest debt that way. And finally, financial bliss is within reach. If you've committed one or more of these sins, don't be discouraged. You're not alone. Every investor stumbles from time to time. Just remember, it's never too late to improve your financial health. Avoid these 7 deadly investor sins from this day forward, and spot in financial Elysium could be yours for the taking. And then they have, now, of course, they do also have, as I said, on their app, good ways to track and do a lot of this stuff, you guys. It's really a good tool. I have done a video in the past on financial capital, my little review. I like it for keeping all my investment accounts. I have several between my wife and I, and it's an easy way to keep it all in one place. Anyway, hope you guys got something out of these 7 deadly sins. Hope you got a takeaway. If you did, give me a thumbs up. If you're new to the channel, think about subscribing. All right, we'll see you again. Bye.